Pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, D, good morning, my friend.
Good morning, Will. How are you?
Good.
And good morning, everyone. I'm going to share my screen here. Today, I think what we'll do is cover quickly a way to look at historical implied volatility crushes, and we're going to use Google in our example. I think we'll make it a short video today because I do have to run. I have some stuff to do right before the market opens.
As we're doing that, was there, I think we had something tomorrow too. Didn't we have something tomorrow?
Yeah, so tomorrow, and I have I
Yeah.
have something in the morning tomorrow that I can't do this show. So we're gonna start on Monday. So
this is the last show of the week, and Monday actually is MLK. It's a holiday, so
okay.
we will be back on Tuesday of next week.
We'll be back on Tuesday.
Yeah.
Before we get started, I'm going to tell you how to get to this page. If you type in a symbol, we're going to do Google up top. You will land on the summary page, and under earnings, we have on the left-hand side earnings moves and IV crush. So click on that, and we come to this page, and we have a couple tabs here to go through. The first page is kind of a summary page, and then this tab compares the historical implied moves based on the option prices right before earnings and compares that to the actual stock move the next day if we measure it from close to close. And one of the things that traders look at is also the implied volatility. Where does the implied volatility tend to close after the earnings? So we have implied volatility right before earnings, and then what does it do the next day? Because the event is out, earnings are released, there's trading. Where does the implied volatility tend to fall to? And when we look at implied vols, keep in mind, and we always say this, implied volatility comes from option prices. It's not something where, with a stock price where, oh, here's an implied volatility just to trade. It's a derived value from option prices, and you always have to define, well, which implied volatility am I referencing? Based on strike, expiration, call, put, bid price, offer, ask price. And to basically create a benchmark that we could track from day to day, we'd have to standardize it. So we'd have to say, okay, what's the, days to expiration? What are the strikes that we're referencing? So we have this 30-day IV, which is a 30-day constant maturity at the money implied volatility. And since we don't have an exact option to reference, we come up with a model or formula to track a 30-day constant maturity IV, just like the VIX does, right? And that's what we're looking at when we look at this implied volatility crush. How did the 30-day IV tend to get priced before and after earnings? Okay. And here we have this summary, and we could see that right before earnings, the 30-day IV. So keeping it, this isn't looking at the 1-day option. It's not looking at the 1 week option. It's looking at the 30-day constant maturity. The implied volatility on average was 37.1. Okay, this is looking at the historicals. The day after earnings, it releases earnings at the end of the day. it falls to 27.9 on average. So if we're just looking at averages here, we could see that there's a 25% decline in implied volatility on the 30-day IV, okay, at the monies. So this gives us some historical benchmarks to look at. Of course, sometimes it would be higher, sometimes lower. These are the averages. If we wanted to look at the historical data closer, we could scroll down this table. And one more thing here we do have, I forgot to mention, how does the 30-day IV look 5 days later? And the idea there is, okay, does the implied volatility tend to, when it declines, does it tend to, decline, is it overdone and then it climbs back up, or does it continue to decline or stay right there as the days go on? And here it says, well, 5 days later, on average, it's 26.8. So it looks like it continues to decline as you go out further in time, 5 days later. If we wanted to see the table of these observations, here we have the last 12 earnings, and we could see in Google, what the implied volatility was the 5 days before, 4 days, all the way to the day before. So this would be where the implied volatility closed right before earnings. So these are the observations. So you could see the average was 37.1, but it ranged as high as 48.2 and as low as 24.4. And this is important too, because if we were below average or above average, with the upcoming earnings, we could also see how far away we are, or how close we are to the historical high or low range. If we're a little bit below 35, 30, 34, we could see that it's still closer to the average than the low. And if we're trading like, 30, 39 or, 40, we're still above the average, but not at the high range of the historical average. Where does it fall to? So we could see here, these are the day after closing. So on average, 27.9. You can see here also the ranges high as 36.7 and as low as 19.6. So these are quick reference points if we're looking at the implied volatilities, and let's say the earnings are somewhere within this table range. We could see here this table in particular starts 5 days before the earnings announcement and goes all the way out 5 days after, to here. So it's a quick reference table to see and compare the current implied volatility and where it falls within its historical range. Another thing we have here is the graph. So here, this is the graph of the implied volatilities by observation. So you can see here, these are all the different observations. And in the orange line, this is the implied volatility before earnings, and then the green line is after, so the 5 days after. And this allows you to look at it graphically, a 5-day graph, over time. And then we could see maybe potentially spot trends if, the overall line is shifting lower. Here, it seems like it's pretty, consistent. 1, 2, 3, 4, 5, 6. Did something similar, it seems like. Prior to that, we're the data points look like they're shifted higher. And one more thing before I go is, if we wanted to just take a look at quickly some strategies that are based on the implied volatility term structure. So this is where, you know, you're trading one option versus another. So spread, for example, if you're doing a vertical spread, you know, you're trading one strike versus another strike in the same expiration. But a time spread is looking at different expirations, which is a implied volatility skew based on term structure. Okay, and some of the strategies are, you know, call calendar spread, put calendar spread, or even diagonal. So how did a call calendar spread do? If you sold the near term option and bought a further term option, both that both straddle the earnings. So both of them will cover earnings, you know, the day before to the day after. So you could see selling the near, buying the far, on average lost 14% and only had a 30% win rate. So what would that mean is that if you're buying the near, selling the far, after expiration, that further term option, right, tended to lose more in value than the near term, even though the implied volatilities are different, their vegas are different, right? So keep in mind the vega of the options are different. In one implied volatility click in the near term does not translate to one volatility click in the far term, as far as, you know, the change in option value. So an option value in the near term for one volatility click could change by a penny or two. If you go out further, that option could change by 10 cents, 20 cents for one volatility click. So even though their implied vols are different, the vega of the options are also different. Their sensitivities to an implied volatility change are different, and you have to consider that. So here we could see that selling near, buying far, on average, was a loser over our observations and only had a 30% success rate. Same thing in the put spread. What about a diagonal? So a diagonal looks at buying or selling near and then buying and selling far, but different strikes. So you got different expirations and different strikes. So this diagonal setup looks at buying in at the money near term and selling in out of the money far term. And the idea there is if you're buying in at the money and selling in out of the money, you're bullish, right? Because you're buying the lower strike, selling the higher strike, in a sense. So you want in this situation the stock to go higher. Plus you're buying implied volatility in vega in the short term, selling in the out term. So if the stock goes up or tends to go up and implied volatility then gets crushed, well, it's getting crushed more on that strike it's going near. So how does that strategy work? And you could see it's almost a break even and 1% gain, but at 58% of the time it had a success rate. This is going the other way. This would be more like a bearish, because they're buying a put at the money, selling an out of the money put, but on different expirations. This was a 6% on average loser with a success rate of 50%. So if you click on this, it'll show you even more strategies. And this is a quick page to get an idea how the implied volatilities moved historically in Google, leading up to earnings, the day after earnings, and leading out of earnings. The magnitude of the implied volatility moves and where it tended to settle, the ranges it settled in, and how did certain strategies perform that try to capitalize on implied volatility skew in the term structure. Okay, so I'm gonna.
Hey, D, we did have a question from. Oh, he's all right. He got it. You did end up showing the chart. I didn't want to get involved. He was asking if you could chart the decline versus the price action. So no worries. Thanks for the question, Rob. I'm glad D showed what you were looking for. I just didn't want to interrupt the presentation at that point. I was going to wait to the end. Great job as always, D. Thanks for bringing it. Remember, everyone, we will be out tomorrow and Monday. It's a 3-day national holiday. So everyone enjoy the weekend. Have a great trading day today and tomorrow. D, you have a good day, my friend.
Yep. Thanks, everyone. Stay safe out there. Have a great trading day. A great